It's a rainy evening in Milan, 2015. Marco Da Rin sits across from Lucia, an eager entrepreneur with a pitch that sounds promising but has a glaring problem: no clear path to funding. They talk through investor fears, rounds of dilution, and the relentless chase for valuation. But here's the twist: most startups fail not because ideas are bad, but because the money dance is misunderstood. So how do you turn those shaky first meetings into a money-raising machine? Stick around. At first glance, entrepreneurs and investors seem natural enemies. One wants control, the other wants growth. But their fates are intertwined in ways you don't expect. Take the case of Marco's friend Filippo in Rome, who brought a brilliant app to market. In early talks, his pitch dazzled but missed the investors' actual concerns about exit strategy. This mismatch cost him crucial seed money until both sides learned to speak each other's language, showing that a good entrepreneur-investor match needs shared goals, not just goodwill. Think of funding rounds as a series of increasingly serious commitments, like a dance progressing from first date to engagement. Early seed investors take big risks for small slices, while later investors expect more proof and demand different control terms. Each step requires negotiation, trust, and a clear understanding of how much control you're willing to cede. It's about balancing passion with pragmatism. When a startup collapses, it's not just the money lost. Investors and entrepreneurs carry those scars into their next deal. Da Rin shows how early failures teach crucial lessons, like refining term sheets or improving due diligence, that reshape the ecosystem. Surprisingly, these lessons sometimes foster stronger ventures later, proving that failure is an investor's and entrepreneur's expensive but invaluable teacher. Entrepreneurial finance looks like a labyrinth of terms, from equity to convertible notes, and it's easy to get lost. But knowing the language is like holding the treasure map. Marco recounts Carmine's early days in Turin, when he confused giving up equity with taking a loan. Equity means selling a slice of your company, debt is borrowing money with fixed repayments. Carmine's costly misunderstanding almost cost his startup future control and profits, highlighting why entrepreneurs need to grasp these basics before signing anything. Valuation isn't a fixed number but a forecast wrapped in uncertainty, akin to predicting the weather months in advance. Investors and entrepreneurs each hold their own forecasts and biases. Da Rin compares it to forecast models where data is patchy but decisions must be immediate. This explains why valuations are part science, part art, a dynamic tug-of-war fueled by hope and metrics. Convertible notes are financial stealth tools, like secret weapons that delay valuation battles until a startup proves itself. Marco illustrates how this hybrid debt equity tool gave Lucia's startup breathing space to grow without early dilution. It's a clever bridge. It reduces pressure, keeps investor interests aligned, and buys time in an unpredictable journey toward growth. Raising money is just a start. The real magic, using that cash to fuel growth without losing control or sanity. Marco tells how Elena, a young founder in Venice, neglected cash flow management after a mega seed round. Despite a fat bank balance, she ran into supply chain chaos by month 6. Cash flow isn't glamorous, but skipping vigilance is fatal. Da Rin argues it's the pulse check that keeps startups alive: no cash, no growth, simple as that. Dilution is the stealthy erosion of ownership everyone fears, but often hides beneath rose-colored glasses. Imagine slicing a pizza thinner with every new investor, a bigger table but smaller slices. Entrepreneurs must choose: more investors for growth or more control for autonomy. Da Rin's data shows founders who understand dilution upfront navigate fundraisers with fewer surprises and preserve their vision. Not all investors are created equal. Angel investors, VCs, corporate investors, each brings unique pressures and perks. Marco illustrates this with a Berlin startup that switched from an impatient VC pushing for quick returns to a patient corporate investor helping scale sustainably. Understanding the temperament and strategy of your backers can mean the difference between burnout and breakthrough. Remember that rainy Milan night and Lucia's pitch? When you understand the messy, emotional, tough money dance between entrepreneurs and investors, the game changes. Fundamentals of entrepreneurial finance isn't just jargon, it's your secret weapon to navigate funding, avoid heartbreak, and turn ideas into rocket ships. So here's your try this. Next time you pitch or negotiate, ask not just for money, but for shared vision. Subscribe for more book summaries like this one.